The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A risk-on day for Wall Street as the lights-off situation in Washington nears resolution. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here on this Monday. And boy, we have a lot to talk about. Let's start with the S&P 500 higher by 1.5% right now, led in a big way by big tech, up by more than 2%. Risk on, as Romaine said, maybe an end in sight for that government shutdown. You can see the bond market selling off a little bit. I stress a little bit. 10-year yields higher by about 1 basis point. It's interesting watching what's going on with gold higher by 2.8% right now. You might say that looks out of alignment with what we're seeing in equities, but Romaine Bostick says maybe this has to do with rate cut bets coming back, and I believe him.
I appreciate that, Katie. The vibes today, of course, doing a lot better, a lot more optimistic out there than where we were just a few days ago. The game of chicken in Washington over the federal budget softening just a bit. We're still not out of the woods. But when you think about that improvement in vibes, well, how could it not? Think about the airport chaos over the weekend, unpaid air traffic controllers calling out sick in protest. 1,500 flight cancellations on Friday. You had 2,000 on Saturday, 3,500 on Sunday, and at 3 p.m. on this Monday, 2,600 and counting. Senate Democrats appear willing to cave. Trump says he's ready to sign off on a deal. And House Speaker Mike Johnson, he sees a light at the end of the shutdown tunnel.
I'm thankful to welcome you to what appears to be the beginning of the end of the longest government shutdown in U.S. history, as shameful as that is.
And that longest shutdown in history is now in day 41. 41 days since the lights went out in Washington. And while the visual from airports are alarming, for airlines, believe it or not, the financial impact has been minimal and to some degree a net positive. Margins, according to some analysts, likely to get a bump as carriers remove smaller aircraft from schedules along with less profitable flights to meet the government capacity rollback mandate. That's the silver lining. Here's the flip side, though. That could be found in managed healthcare stocks down for an 8th session in the past 10, as one of the key sticking points in those congressional negotiations was an extension of those Obamacare benefits, an extension that for now doesn't actually appear to be part of any deal. Centene, Tenet, Oscar Health, they're dropping today, Katie, by the most intraday since at least July.
We're going to follow that. I find it remarkable you're restrained in not mentioning your own airport chaos.
I'm going to make this about me later in the show.
During the show. Let's take a look, though, at the betting odds when it comes to how long the shutdown might extend. Of course, we saw a lot of green shoots over the weekend, perhaps that we're going to reach some sort of resolution here. Chaos at the airport certainly would help speed the process along. And you can see that reflected in the Kalshi odds of this U.S. government shutdown lasting longer than 45 days, which would take us through the end of Friday, I believe, past Friday. You can see that those odds have plummeted to about 20% right now. What I find interesting is that just a couple days ago, we were looking at odds of greater than 70%, Romaine, and then you saw this steep drop-off. Really speaks to just how quickly things started to move over the last couple of days. The fact that even the betting markets were kind of taken by surprise, that we were able to see these two sides start to come closer together, and now sitting at about 20% odds that maybe we get through Friday and get this government shut down, or reopened, that is.
Yeah, absolutely. And we should point out, based on the deal that the Democrats in the Senate appear poised to back, we should point out that President Trump has said that he is ready to actually back that bipartisan deal as well. The big sticking point, though, is not going to be in the Senate. It's really with the House Democrats. Many, Katie, as you know, are actually starting to dig in their heels. Some of them actually alarmed at their own colleagues in the Senate for actually agreeing to this without any sort of concession when it comes to the Affordable Care Act subsidies. And this gets to the idea that when you talk about the big rally that we're seeing in stocks today, a bit of an extension of what we saw in Friday, is whether this is maybe a little too soon to start popping the champagne corks, particularly given that even if they do reach a deal, it could be several days, even a couple of weeks before we get back to any sort of sense of normalcy.
That's the thing, and that's where it still matters for the Federal Reserve and for investors, because should we get the government reopened, think about what that would mean in terms of the data calendar. We've been without data for quite a while here. We've missed at least 2 employment prints, and we might actually get a bit of a deluge when the government does reopen, but you have to think about the quality of that data, because the on-the-ground data collection hasn't been up and running. So just the government being reopened, you're still not going to get the data that you necessarily need.
And there's another big issue, too, hear, and it does have to do with what we saw in the airports over the weekend. And I'm not saying that just because I was traveling. By the way, I haven't slept in 36 hours. But it gets to this idea. Yeah, I mean, I got in at 4 a.m. this morning, just a torturous trip trying to get back up here to New York. But the visual optics of this, I think, are what kind of forces the issue, right? You have a lot of people that either weren't aware of the shutdown or at least didn't think it really mattered to them. But when they're sitting in the airport and seeing their flight delayed and then canceled and then realizing they can't even book another flight to get out of whatever city they're in for 48, even 72 hours, all of a sudden there's an awareness here, and that puts a lot of pressure on the politicians to say, okay, maybe we pull the plug on this.
Absolutely. I saw a stat from FlightAware that more than 1,800 flights were canceled. Again, something you're intimately aware of, but that's when it really becomes tangible to the greater populace that the government is not functioning right now in terms of keeping these airports open and flights in the sky. That's where it really starts to impact the day-to-day lived experience of Americans.
And we've heard earlier today, from Sean Duffy, the administrator, as well as a few other transportation officials, not very encouraging, because at the end of the day, they're still kind of talking circles about, pointing fingers at this party or that party for the reasons. But at the end of the day, you have air traffic controllers who, as of tomorrow, are going to be out 2 paychecks that they haven't received. A lot of them are calling in sick. And of course, this is a highly skilled job. It's a job that is not really replaceable. Remember, you're not allowed, based on the rules here in the U.S., to even hire anyone for an air traffic control position who's over the age of 31. So you basically have to be in the pipeline by then. The training to do that is something like 2 to 5 years. So if you lose these people permanently, it could take years before you can find a viable replacement for them. And we're already talking about an air traffic system that, as we know, was already stressed even before the shutdown.
That's the thing. We've been talking about this shortage in air traffic controllers for months now. This well predates, of course, the start of this shutdown. So as you say, if these people were to be permanently removed, you have to wonder where that leaves our entire air traffic system. Interesting, though, to see stocks rallying right now. Who knows whether or not this will be resolved by Friday. That's what the betting markets would suggest. But even still, there's that 20% chance that it doesn't get resolved. I don't know how much you want to put just on the betting markets, but there is the idea out there that you articulate that this is a lot of enthusiasm, and maybe it's a little bit premature.
Well, and that's been going around too. And I just want to kind of point out too, because I was looking at some of the data by FlightAware in terms of the number of delays. We're like 19,000 today, 2,400 cancellations today. That's a little bit less, believe it or not, than what we had yesterday. But of course, the day's not over.
No.
Right. And we talk about this idea of how do you get back to some sense of normalcy. Let's bring George Ferguson into this conversation, who covers the airline industry for us over at Bloomberg Intelligence. And George, if we have you there, maybe you could kind of chime in on where we stand right now. I mean, looking at the numbers for the number of delays and cancellations. Now, we're nowhere near some of the big sort of blowouts that we've seen and when we've had huge weather disruptions in the past. But it is significant. And I just want to share a personal anecdote. I was talking to one of the gate agents at Delta, and he was kind of talking about why they were in the position they were in. It wasn't just the air traffic controllers, not to mention the fact that a lot of TSA agents also are on the clock as well. But a lot of folks who actually are working for the airlines and getting paid have also decided not to be there because of the added stress of dealing with all these angry customers who are trying to find a way to get home.
Yeah, I know. I mean, obviously, this sort of thing feeds on itself, and so that becomes part of the challenge. But I think, the biggest issue, obviously, is sort of controllers and TSA agents. I think that's going to be the bulk of the challenge. And when they're not paid, some of them are looking for ways to manage childcare. Others are not willing to pick up second shifts. But I think right now, really, we look at the airlines. What we see is just, we're kind of in the mid-single-digit percentages of cancellations, which from the airline's perspective isn't terribly challenging. Like, I think they're probably, what we've seen is they're nixing a lot of smaller flights, so they're nixing the airplanes that are 76 seats or less, a lot of the regional business. They're probably cutting unprofitable flying. So from an airline profitability perspective right now, and I kind of hate to just use that as the only measure for whether, how bad the situation is, we don't see a major sort of effects on their financials for this quarter. Now, as we get closer to Thanksgiving and more interruptions trickle through the system, we get above 10%, then I get to get more worried about it. And of course, I'm not that person stuck in Memphis trying to get home to Newark and frustrated at a gate agent. So.
And it's not just Memphis, George. It's Miami. It's Florida. It's Fort Lauderdale. It's Palm Beach. Do you know how hard it was, Katie, to even get into an airport lounge?
You know, I really feel
it's a 2-hour wait.
And you were in the building early this morning, too. So hats off to Romaine here, battling back from Miami. But, George, I want to talk a little bit more about those air traffic controllers, because we were just having this conversation that these issues, these shortages, they predate this shutdown. And I wonder, you know, if this is something that's only going to be exacerbated by this experience.
Yeah, I mean, look, I think that it doesn't improve the allure of the career to know that you can be stuck in a situation where, because of political reasons above you that are very uncontrollable to you, you're not going to get paid for a couple months, right? And these people they're not getting salaries that I think would allow them to miss a lot of paychecks and keep chugging along. And prior to this, we were already having problems recruiting controllers. I think it's kind of lost some of the allure maybe it had back a long time ago when I was looking for a career. I think tech has sort of beaten it out for careers that are more interesting. There's a lot of careers you can do from home, so you don't have to go to the office every day. That hurts it, and there's a lot of stress in the controller industry. And so I do think it's been a challenge. I think there probably needs to be some pay increases in that business and some technology improvements. And for sure, this is not going to help out that recruiting.
Well, maybe this ends up being a potential inflection point, though I won't get my hopes up. George Ferguson over at Bloomberg Intelligence, kicking us off to the close. We got a lot more coming up, including a conversation with Paul Krugman about the shutdown and the economy. Michal Katz over at Mizuho to talk about M&A and a closer look at the market action and what's really driving the fundamental moves beyond the day-to-day headlines with the head of North American equities at Columbia Threadneedle Investments. This is The Close on Bloomberg.
Wall Street traders risk on again in the hopes that the Senate will vote in favor of a measure to end America's longest government shutdown, passing it off to the House. But our next guest says that the real market drivers will be a continued evolution of tire. Trade, inflation, rates, and earnings. Let's discuss with Nicolas, Janvier, head of North American equities at Columbia Threadneedle Investments. Nick, great to have you with us. I noticed that it was tire, not tires. Shutdown wasn't in there, and that certainly seems to be front and center in the market's mind today. Romaine and I were having a conversation about whether or not some of this enthusiasm was premature, and I wonder where you fall on that.
Yeah, look, I think to the extent that you have the government open back up and we get to some level of normality, that's without a question a positive for markets, right? But I think in the long run, this is something that in just in a matter of weeks we're not going to be talking about, and we probably are going to, rightfully so, refocus on what's happening with earnings, because that's where the real action is.
Well, let's talk a little bit more about earnings, because, of course, we had the big tech names a couple of weeks ago, but then we had a lot of these more consumer-facing names, especially in the restaurant space, and it was a really mixed read, and I wonder what that says about just the state of things in corporate America right now.
Yeah, I would say, Katie, I would say it was more than mixed. I would say it was probably decidedly negative, and about as negative as we've seen in some time. So I think without question, you're starting to see some evidence that the low-end consumer is struggling. We know the totality of everything that's happening out there in the economy, but the reality of it is that people have a budget. The budget is stretched, and they're having to make choices, and places like perhaps Sweet Green are suffering as a result of that.
Does this become sort of a broader problem for the market, though? I understand you're going to have certain pockets that are exposed to that consumer that are suffering, sort of like some of the restaurant chains, if you will. But as long as you have this AI spending, this CapEx spending, at least in that tech sector, is that enough to keep this market going? Yeah,
I would say going back specific to the consumer, not yet. And not yet because I would juxtapose that with what's happening with the higher end of the consumer spectrum. And that's where most of the spending in this country is happening. I'll take you back to Delta Airlines a couple of weeks ago that pointed out that they've seen the biggest divergence in terms of bookings in the back of the cabin versus the front of the cabin. So there is a consumer here that is doing well. They've seen their wealth elevated by what's happening in the market, and they're spending. So it's not a problem for the economy at large yet.
Yeah, because, I mean, there's been of course, a lot of hay made by some of the comments that we've heard from Ed Bastian and some of the other airline CEOs. You can depend on those high-end customers, but only to an extent. At some point, you got to fill the back of the plane, and if people don't have money, I assume that catches up with them. To that point, I do want to just raise the specter of this idea of kind of what is actually being bought in this market. I mean, we talk a lot about big tech, but it's more than that. You're seeing a lot of sort of meme stocks and sort of the riskier plays here. And I am curious as what that says about investor sentiment, whether we are trading on economic fundamentals or on just speculation or whatever you want to call it.
I would say the market is very bifurcated here, right? You have the higher end of the market, we'll call it the hyperscalers, the cloud-driven names. Those are absolutely being driven by the fundamentals, right? All you have to do is take a look at the CapEx numbers that have been put forth. But on the other end, you are seeing some degree of speculation. I would point to you quantum computing names, right, that have melted up, some of them matter of thousands of percent over the last 18 months. But in some ways, that's what you expect to see in a bull market, right? There is expectation. People are looking for different ways to make money. And, you know, along with the good stuff, you are going to get some speculative appetite. But that's what happens in markets like we're living through today.
It is interesting to see all that speculation still existing when you still have interest rates relatively high. This isn't a zero interest rate phenomenon anymore. But before we let you go, I am curious, you know, you think about the consumer-facing names, some of them that we mentioned, and then you mentioned, you know, some of the hyperscalers and all the businesses that are just spending money basically in a circle on each other. What looks like the better way to invest in a portfolio? Do you gravitate more towards the businesses that are benefiting from business spend or more towards the companies that rely on consumers?
I would say all the above, right? There aren't a lot of sort of secret formulas in the world, but one that has held true over time in investing is that you want diversification. And I think what you're describing is a very clear example of that. Just one more thing that I would point out, Katie. I think we are at a point of the cycle where it's important for investors to pay attention, not just diversification from a sector perspective, but diversification across the different themes that are being invested in a portfolio, because you can recreate AI in just about every sector now, and that would not be a very diversified portfolio.
Nick, great to have you.
Thank you very much.
Nick Janvier, head of North American equities at Columbia Threadneedle Investments, and then with a big focus on the government shutdown and the economy. Who better to talk to than Paul Krugman, Nobel laureate, joins us right now here on The Close. And Professor Krugman, I do want to start off first with the shutdown. I mean, I was told heading into the shutdown, the shutdowns don't necessarily matter. They don't matter for the economy. They don't necessarily matter for the stock market. As somebody who spent, you know, quite a onerous time trying to get back home over this weekend on an airplane, I can assure you it does matter. Is there any way to sort of quantify what the potential impact is of a 41-day and counting government shutdown?
It's really hard to pin down. We can talk about the impact on spending. We can talk about laid off federal employees and the, you know, what the money they don't spend, but nobody has ever really tried to quantify, as far as I know, the effects of air traffic control delays. I mean, what we're learning is that actually we kind of need a functioning government to have a functioning economy. This wasn't long enough to really do a lot of damage, but it was enough to show us, you know, a 6-month shutdown would have been really, really bad. So it's significant. It's bigger than the standard macroeconomic analyses would suggest.
I am curious, though, about just kind of the state of the economy heading into this shutdown. The idea that even if we do strike a deal over the next couple of days, it could take a couple of weeks to get back to anything resembling normalcy. When you look at the state of the economy prior to the shutdown, how fragile, if at all, did you see it to be?
Well, there's two things I would say. First, you know, the shutdown, at least the chosen issue, involved health insurance, involved the enhanced benefits, which are turning into which are going away on the Affordable Care Act, and Democrats caved on that. So 22 million Americans who have subsidized Obamacare insurance are about to see, or are in the process of seeing, gigantic increases in their health insurance premiums, an average of 114%, according to Kaiser Family Foundation. And that is happening. That's happening despite the fact that the shutdown is over. So that's a pretty big factor. That's a pretty big hit, certainly to the finances of a lot of families, and probably some knock-on effects on the economy as a whole. The other thing you see is that people are really, really down on the economy. I mean, we talked about a vibe session under Biden, but the vibe session now, I mean, the economy ain't as great as Trump claims. Grocery prices are not, in fact, way down, but people are really, really negative. We have the worst consumer sentiment about current economic conditions, basically ever. Not just worse than the 2022 when we had 9% inflation, but
Right.
worse than the aftermath of the financial crisis, worse than the stagflation of 1980. People are really, really down on this economy, and I have to say, I don't think that the way this drama has been playing out is going to change that. If anything, we're likely to see, I was just hearing the tail end of what you're saying, ordinary people. People who are not in on the stock market are hurting and feeling extremely stressed.
Well, Paul, it's interesting that, coming out of this shutdown, one of the consequences is that we're going to get economic data figures to actually put some numbers to this economy's performance. But you think about some of the reports that have been delayed, at least 2 employment reports, CPI, PCE as well. It's unlikely that the BLS has been able to collect and actually process the data for some of these reports. And with that in mind, I wonder, what kind of quality we can expect in terms of trying to put some context around these vibes.
Yeah, we're going to have a ghost month. It appears that on labor market data, there will simply be a month that we know, anything could have happened in there. The BLS will never be able to catch up on that lost data. And we do worry a lot. I mean, there's been a problem with declining response rates and understaffed BLS even before. So the data quality is going to be a real issue. And, we're all looking at the soft data, the private surveys, none of which says that the economy is falling off a cliff, but a lot of which is at least a little bit alarming. And I'm particularly struck. I've been looking at Conference Board on are jobs plentiful or are they hard to get? And that number hasn't fallen off a cliff. People feel really, really bad about job prospects right now in ways that the BLS numbers weren't showing before, but does suggest a kind of frozen labor market in which people, if you're if you're young, just getting in, or if you've been laid off, it's a really tough world out there. So this is going to be, I mean, it doesn't look like, it doesn't look like September 2008 with everything falling off a cliff, but it does kind of feel like this is starting to feel like a tough economy. And as I said, ordinary people are extremely pessimistic about the state of affairs.
Well, Paul, we only have about a minute left with you, but to that point, we saw a social media post from the president this morning saying that all money left over from the $2,000 payments made to low and middle income USA citizens from the massive tariff income pouring into the country will be substantial. The point being that we are discussing these one-time payments, $2,000, these dividend checks, if you will. Do you think that that's a good idea?
No, it's a terrible idea. I mean, we have an enormous budget deficit. The tariff revenue, which is, by the way, coming in substantially below what Trump administration officials said it was going to be. It's substantial, but it's not what they said it would be. It just makes a small dent in the enormous deficit. The fundamental fact is that the U.S. government is spending in ways that, I've been a long-term dove in terms of concerns about federal debt, and I don't think we're facing a crisis anytime soon, but we are certainly running given the absence of a national emergency, given the absence of a pandemic or a war, to be running deficits this large is just irresponsible. And the idea that, hey, we're going to take one source of revenue and use it to hand out money when we're meanwhile going ever deeper into federal debt, that's deeply irresponsible.
All right, Paul, got to leave it there. Really great to get some time with you. That is Nobel Prize winning economist Paul Krugman, distinguished professor of economics at the City University of New York, also the author of the Substack Krugman Wonks Out. Coming up, we're talking about deal making. Don't go anywhere. This is The Close.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Not quite at session highs on the S&P 500. Pretty dang close, though. And I wanted to talk a little bit about Papa John's. Have you been following this one?
I have been following the saga of Papa John's, and apparently that saga's gotten a little bit deeper today.
Yeah, according to ABC Money UK, apparently there's a report circulating. I hadn't heard of it either,
right.
but legit publication circulating a report that the pizza chain is nearing a potential all-cash acquisition deal by a consortium led by Tri-Artisan Capital Advisors. This comes after reports that Apollo withdrawing its take-private bid. So Papa John's a hot commodity here.
Yeah, and we should point out, I mean, there has been a lot of deals. Remember last Monday, that was a huge merger Monday. You had a couple of deals, obviously, with Papa John's, Treehouse also in there, and you add that all up. I mean, we're basically tracking in around $4 trillion in deals so far this year, which is well above where we were last year at this time, and it kind of defies a lot of expectations coming into this year where people kind of thought things might be a little softer.
Yeah, absolutely. Think of where we were even 6 months ago. It feels like a totally different landscape. So let's keep this conversation going, of course, because we're talking about a string of M&A, putting 2025 on track to become one of the top years for deal making. Joining us now is Michal Katz, Head of Investment and Corporate Banking over at Mizuho Americas. Great to have you on set with us.
Thank you for having me.
So let's start there because, again, you think about the landscape towards the beginning and certainly the middle part of this year, it was much different. We didn't see M&A coming back really in a big way. Now you fast forward, we're heading to the end of 2025, and it seems like we just keep accelerating. So I'm curious, in your view, what's behind that ramp up that we've seen over the past few months?
No, absolutely. 2025 has been the rebound in deal making across both M&A as well as capital markets. And this pause you had talked about post-Liberation Day had been very short-lived. And in fact, each successive quarter has seen an increase in deal-making activity. And it's really been underpinned by three factors. One has been the mega deals that we've been talking about, the $85 billion rail transaction, Union Pacific, as well as other mega trades across sectors. Second, which we just talked about, is the return of private equity. We saw the largest buyout ever with Electronic Arts. And so private equity has been sitting on the sidelines during the rising rate environment and very much eager to put money to work. And then the third thing is that we've seen is the return of the IPO debut, the IPO opportunities. Now, not all have performed perfectly, but nonetheless, it is nice to see it broadening out beyond tech into healthcare and other sectors as well.
Can I just ask you, though, on the private equity, I mean, we came into this year, and I mean, you look at the number of sort of captive portfolio companies under that PE umbrella. I know we've got a few that have managed to sort of exit into the IPO world, but that still leaves, I don't know, probably like, 25,000 that are still sitting out there. When did those come out?
That is obviously the 30,000 company question out there. But look, I think that what we're looking for is obviously stabilization and normalization in the market. You are looking for the VIX to be below 20. Second thing is you need to show that asset class cohort performing well in the aftermarket. And you also need to have reasonable valuation expectation. When you're looking at the markets, I do think that there has been a bit of a disconnect between how the economy has been performing and where the markets have been. They've not always moved in lockstep this past year. And so you are looking at valuation that are fairly stretched. And there has to be this calibration by both private equity as well as the venture community is at what valuation are you willing and able to take your companies out into the public markets.
I want to put this conversation in the context of some of the cockroaches that have started to appear in the private credit landscape, and maybe not just the private credit landscape. I know there's a little bit of a blame game going on right there, but you think about First Brands, you think about Tricolor, then you think about what BlackRock is going through with Renovo Home Partners. As these maybe idiosyncratic issues start to pop up, do you think that that will put any sort of dampening effect on this resurgence that we're seeing in not just M&A, but potentially even the IPO space as well?
Look, those situation that you have mentioned are clearly demonstrating that there are some stresses in the system around certain sectors and perhaps certain companies. While we do think that those are idiosyncratic and not systemic, I do think that the pushback now that we're seeing from both lenders as well as investors are very much called for. You talked about private credit. That asset class has quadrupled over the last 15 years and clearly fueled competition for assets, which with it brought along very issuer-friendly covenants, terms, and what have you. So perhaps this pendulum swinging back some is bringing back increased rigor, increased discipline, maybe more transparency, more documentation. But I would quote one of your prior guests on this show that basically said you can't do a good deal with a bad actor. And so understanding who is your counterparty, understanding who is your borrower is very much critical to getting a good deal done.
On that point, though, there's also obviously been a lot of activity in the AI data center space and beyond. And I am curious, there seems to be a lot of froth, if you will, in that space. And I'm wondering how you sort of discern what's sort of real, what is sort of viable as a sort of AI investment relative to some of the stuff that just has AI kind of slapped on as a veneer.
No, it's a great question.
Yeah.
I mean, I would call it, that's the $5 trillion plus question. And clearly this is a once in a generation transformational disruptive technology that is upending sectors, companies, employees, what have you. And the concerns that are being voiced out there are real. Is capacity exceeding demand? Are we seeing the return of investment? Is there too much concentration? And so the question we ask ourselves when we look to support some of the sponsors and on those transactions is, who are the sponsors? Who are the off-takers? What are the contracts? What is the utilization? Because I would tell you, the analogy or the parallels that are being drawn to the 99, 2000 hype are not, I would just say that's an oversimplification. Back then, we had less than 10% of global fiber networks being utilized, whereas today you have 80% or so GPU deployments that are actually being utilized, and only 15% or so is viewed to be used for AI training, where the rest is going toward cloud and other applications. And so the question becomes again, who are the actors, who are the sponsors, who are the off-takers, what are the contracts, and what is the pricing behind it? But your question around froth, I think that you do need to be incredibly discerning. But what we're seeing right now in the market is that the fear of missing out is overshadowing and eclipsing the fear of, to me, a fear of any failure.
Well, speaking of froth and potential FOMO, I'm so curious to get your thoughts on what we saw transpire in the healthcare industry over the past few weeks. Of course, Pfizer and Novo locked in a bidding war for Metsera. It seems like that has been resolved in Pfizer's favor. Do you think that that's a truly unique situation, or are bidding wars something that we might see more of in 2026?
I would tell you that most companies prefer to avoid bidding wars and prefer bilateral negotiations. But when you have a scarcity of assets or asset that could have an outsized impact on your business, we do see this competition for assets in the market.
I have to ask you just about your own travels. I mean, I keep tabs on you. It seems like you're all over the world, but you have kind of a good vantage point because you get to speak to a lot of executives and you kind of get to see globally where people's head is at. And I am curious as to, are they feeling ambitious? Are they feeling optimistic? Are they worried about what's going on in the world? What are you hearing?
I would say yes, yes, and yes. So this activity and deal making has been global in nature. In fact, cross-border M&A is at a 5-year high. I think it's 28-30% of global M&A volume. But I would say they're really underpinned by a couple of different dynamics. First one, I would say, what are some of the strategic imperatives? Some companies need, scale to grow. Others are kind of shrinking in order to optimize their core assets. Others are looking for redundancy to create redundancy in supply chain. So those are very much strategic in nature. I do want to highlight, though, the regional imperatives that are out there. You have Japan, for example, which is Mizuho's home market, where there's this economic revitalization happening, and that's very much supported by governmental policy and the desire to improve governance. Or Saudi, where I just came back from FII, very much a region that's looking to diversify away from hydrocarbons and oil into the broader economy and actually become the third market for AI with their huge humane asset. And similarly with Europe, we've talked a lot about the increase in defense spending. And then lastly, I would say, as you alluded to it before, which is the number of private companies that are still housed within the private equity community. Those are some structural dynamics that exist where private equity is looking to monetize their portfolio as well as looking to deploy new capital.
Great year so far. You think 2026 is going to be a better year for deal making than 2025?
I do think that the velocity will continue, though the complexion of deal activity may differ some. Whereas we've seen the mega deals, I do hope to achieve greater distribution with more mid-market activity, as well as more activity outside of big tech. And I would also say that any pullback we may see in the market could actually help drive greater M&A activity as asset prices may be more palatable for acquirers.
All right, Michal, really appreciate it.
Great to see you.
All right, one of the best in the business there, Michal Katz, head of investment and corporate banking over at Mizuho Americas, talking about the spate of deals we've seen this year and maybe an increase into 2026. And one of the big deals that we've seen this year, actually, well, that was announced today. Treehouse Foods, shares of that company jumping after European buyout firm Investindustrial agreed to buy the private label food manufacturer for about $2.9 billion, including debt. Joining us right now is the man who helped to lead that deal. He joins us here in Studio 2, Andrea Bonomi, managing principal and founder over at Investindustrial. Great to have you.
Thank you.
So talk about private label overall, because I was under the impression that private label might have been having a little bit more of a struggle relative to some of the brands. But you are obviously seeing value here, longer-term value here, that maybe others don't. Why?
Absolutely. In Europe, private label is senior to brands in most categories. In the United States, it's still junior, it's still a discount product. But you see growth both in Europe, in the United States, and now also Middle East and Asia, which has been a branded market until now. I just heard you talk about Saudi Arabia. We just did a deal in Saudi Arabia where we bought the leading ketchup and vinegar maker there. So the world is becoming bigger for private label.
Well, let's talk about where you see the most opportunity. Just staying with that global perspective right now. I mean, a conversation we were just having with Michal was that there's a lot of cross-border M&A happening. So when you take a look at the country perspective, where do you think the most opportunity is?
Well, it's all over in both hemispheres, both in Asia and in the United States. The global buy and build is the name of the game currently. You have three elements happening at the same time: the de-risking of the supply chain, which looked for a moment as it was a deglobalization, a globalization which is on fire. Don't believe what you're seeing. It's actually very, very strong. And at the same time, a balancing of how global trade is happening. So it's very, very difficult, which creates opportunity, which means people will have to do global buy and build.
I am curious, Andrea. I mean, obviously, you've done some legendary deals over the years, primarily in Europe. And I am curious as to kind of what the state of private markets in Europe are right now, particularly relative to the boom that we've seen here in the United States.
They're behind, and they're growing. They will never be as deep as the United States. They're bigger. Most of the market is private in Europe. The stock markets are much smaller than you have here in the United States, but there is fewer transactions. But they're growing. They're growing. So it's not going to become like the US, where there is a very liquid and very deep market, but it's a very specialized market.
Yeah, fascinating context there, comparing, of course, the European private markets to what we're seeing in the U.S., which has just boomed in recent years. I want to talk about specifically your involvement in the food sector. We're talking about this acquisition for Treehouse. As I understand it, you had already owned a significant portion of their meal prep business. I know that you're involved in Ladoria as well. When you take a look at sort of the sector, the industry perspective, how much more exposure do you want to food specifically?
Well, we already have quite a bit. We do about $12.5 billion of sales in the food and related sectors. So it's a big sector for Investindustrial. We have Italy in the United States. We have Parker Foods, which does ingredients. You've seen a lot of activity also from other Italians, Ferrero buying Kellogg. We are scaled. So I would say for us, food is now, the growth is going to be very much in the United States. In Asia. Not forgetting the United States, because we are opening more and more Italys, for instance. We're opening a Kennedy. We're just opening in Lexington down the road from here. So you're going to see more investment for us.
Do you worry at all about the tariff environment, given just how global some of your brands are? I mean, just this morning we were talking about, Italian pasta basically not being a thing here anymore because of a 107% tariff on them.
No, so tariffs is an unwelcome new event, but it's the rebalancing of the trade is not. So they are cousins with each other. So it's going to cause some disruption, but it will mean that you're going to have not the trade that you had before, but you will have US, Europe, and Asia with different approaches to each country. It will be more solid in due course. Free trade has positives, but from a general point of view, it also has a lot of negatives. So the rebalancing is extremely fast and it's extremely difficult to manage. But we have more than 90 plants in the United States, and we will manage. Yeah. And you mentioned pasta; the same thing will happen with that.
All right, Andrea, great to get some time with you. Really appreciate the time on what I'm sure is a very busy day. That is Andrea Bonomi, managing principal and founder of Investindustrial's Advisors. This is The Close on Bloomberg.
We're just about 10 minutes away from the closing bell. Romaine Bostic here with Katie Greifeld, a redhead crossing the Bloomberg terminal. This on C3AI, ticker AI. Reuters saying that exploring a potential sale and other options. Those shares up 4% here.
Yeah, interesting. Adding to an otherwise pretty bullish picture for equities, the S&P 500. A lot of enthusiasm on this Monday with the end of the shutdown potentially in sight, really being expressed through big tech in particular. The NASDAQ 100 higher by 2.3% right now.
Yeah, I mean, stocks pretty much across the board at session highs, and it gets to this idea as to what's driving it. Is this optimism about the potential government shutdown coming to an end, the resumption of Fed rate cuts, a strong earnings season? What, Katie Greifeld?
I wish I had the answer.
Stick your neck out there.
I would never do that. But the good news is someone is sitting to our right who perhaps does have the answers.
All right, well, let's bring her into the conversation. Sherry Paul, Managing Director and Senior Portfolio Management Director at Morgan Stanley Private Wealth Management. Sherry, always great to see you here.
Thank you.
All right, well, I guess we'll take Katie's question, well, my question to Katie, and I'll just pose it to you here. I mean, when you look at sort of the vibes, if you will, and it's not just today, we saw kind of similar vibes on Friday as well. Is this kind of more of a bet on Fed rate cuts or some resolution to what's going on in Washington? What do you think's driving it?
Well, I love vibes. Yeah. It's my thing. Yeah. I think so I would take a step back. I'm going to hit the timeout button on the bigger picture and remind ourselves that we are in a once-in-a-generation cost-cutting, productivity-enhancing bull market being driven by innovation and funded by enormous historic CapEx spending, both at the corporate and government level. With the deregulation kicker coming in January. And so with that setup, if we start to tease that out across the S&P as we start to see earnings, we've had great earnings, and earnings per share sort of are coming down in terms of PE ratios, that there's no reason that this bull market shouldn't continue.
With regards to just the potential benefits of AI and technology on the productivity and cost side, are there specific industries that you think are benefiting more so than others, or I guess faster than others?
Well, right now I was just actually reading some research that this coming year that most businesses in the S&P 500 are expected to increase their interaction with AI by 50% in the next 6 months. Wow. And so I think that the investment thematics of the infrastructure build out, right? So we've got the enablers, then we are now moving into adopters. And what we're seeing is if you take that top 7 companies, the top 10 out, the other 493, the PE ratios at 19, and you start to sort of install cost savings across the board, we should start to see a lift in the market in a healthier way than we're seeing in the concentration.
Well, I'll ask you a question that I asked Janvier earlier this hour, and that is, where you want to invest right now. Do you want to invest in the companies that are sort of the target of other businesses spending money on them that are benefiting from all this CapEx, or do you want to invest in the companies that consumers are spending money on right now, those consumer-facing companies such as restaurants, apparel makers, and the like?
Well, it's a great question. I think you want to follow the CapEx spending. I mean, the volume of it is so enormous. And what's happening now is that, and this is a stunning moment, I believe, is that investors are able to get sort of these pre-IPO speculative returns in a large cap balance sheet in the public markets right now. And we haven't seen this, you know, I don't believe, at least since I've been investing since the late 90s. Partially because companies are taking longer to go public. So the small cap space, 49% of the companies are not even making earnings right now. So this innovation trade that's sort of percolating and then getting pushed onto large cap balance sheets is giving investors this unique moment. And yes, so follow the CapEx spending, because we are bifurcating in the economy in these traditional ways in which we evaluate the health of the economy versus the opportunity for the stock market to go higher based on profits.
Well, that brings me to another point that I think about a lot. The fact that you are getting these IPO-like returns in mega cap companies with these large caps is the idea that some of these tech companies are like the last true conglomerates, that they buy up all these small companies, and they do have companies that might have IPO'd one day, but they're being bought up by some of these tech giants before they have the chance to. I wonder if that factors in at all, or, you know, would you brake check me here?
No, I completely agree. I think that these are now big holding companies, you know, like where they sit even in the S&P, it's distorting, you know, the sectors and companies that are in communication services but not in discretionary, that are media companies or point of purchase. But I think one of the important notions about that, though, as investors go forward, is all of the above. You know, that this is like an ecosystem that's going to be expanding, you know, throughout the S&P 500.
I want to go back to earnings just for 1 second, because there was some great data out by some of our folks at Bloomberg Intelligence, because it seemed like the narrative most of this earnings season was it was basically big cap tech were the big winners. I mean, they were the winners. But this note kind of pointed out that the other 493 out there actually did pretty well. I mean, at least on when you look at sort of the percentage increase in earnings growth, it was something like double what analysts were expecting heading in. That's in total. And I know there are some pockets of weakness in there. But it gets to this idea as to whether investors see that, whether investors are embracing the other 493, or at least a good pocket of those 493, and not just the Mag 7.
Well, it's tough because, you know, I think, I believe that this, you know, people forget that 2022, the Mag 7 were down 65%. I mean, it's like it's the earnings recession that everybody has forgotten about. So these stocks already reset. At the time, I was calling it the recession obsession, that it was time to stop obsessing about this idea that we were going to go into a recession. So these Mag 7 continue over the last 4 years to contributed more than 50% of the return of the S&P, okay? And so going forward, to Katie's point, there's an opportunity to continue to own them because they really are more like holding companies. There's an embedded diversification and a benefit, and especially when you look at the energy build out. Think about what's happening in the energy ecosystem. In these big mega cap techs are turning into their own self-sufficient, you know, energy sourcing to run data centers. And so that's an interesting point. But, you know, too much of a good thing's a bad thing. Just diversify it out. You have to get every last penny on the tech trade off the table here. But yes, they should be a really important part of every portfolio.
Real quickly, does the Fed still matter?
Well, I'm so glad you asked, because I've been wondering out loud whether or not sort of what I'm calling the old tools of the Fed can meet the mandate of a new economy, and whether or not interest rates still have the impact when you're cutting cost of capital as corporations begin to expand, if that translates into hiring humans, or if it just leads to earnings expansion. And so I think that we're 24 months out on whether or not, you know, the Fed, at least, you know, this is in my opinion, I'm thinking this through, how the Fed is going to be able to meet this moment when growth is not occurring by hiring people, because the innovation trade is designed to mitigate expensive human labor.
Yeah, and we've spoken with some very prominent economists who are kind of worried of exactly how the economists at the Fed sort of address this. Sherry, you have to leave it there. Always great. Sherry, one of the best in the business. Sherry Paul, Managing Director and Senior Portfolio Management Director at Morgan Stanley Private Wealth Management, counting us down to those closing bells, just about 2 minutes away with stocks at session highs. More than 300 stocks in the S&P in the green. A full breakdown of today's action now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. It starts now. Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership here with YouTube on a decidedly risk-on day. Carol Massar, the Nasdaq up more than 2% on the day, the S&P up 1.5.
Everything is totally awesome. At least it is for this Monday, November 10th. Having said that, I've been looking at the semiconductor space. You've got 27 of the 30 names in the stocks. They are up on the day, and I'm just looking at the index. You guys, it's up 3% here. So we have seen investors moving into that space in a big way.
Some cryptos are getting a bid today. Bitcoin up 1.3%, Ether down 0.4%, Tether is pretty much flat right now, Katie. So yeah, even risk on to in a certain sense.
Crypto, is that what we call it? Is that like vinyls? What does that mean?
You got to watch Bloomberg Crypto tomorrow at noon to find out.
Bloomberg Cryptos?
Bloomberg Crypto. Tuesdays at noon.
The Cryptos show. Let's quickly talk about physical Bitcoin. That, of course, is gold, which is really interesting. Just on a tear today, up about 2.8%, at least the last I checked, which kind of feels at odds with what we're seeing in the equity market and the crypto space, if you will. Not really fitting into that risk-on picture, but I don't know the last time that gold was really behaving as a true hedge in the last couple of weeks.
We should point out part of the enthusiasm today is certainly tied to the potential for an end to the record government shutdown, but it's also rising on the back of some relatively strong earnings, and we're expected to get more earnings after the bell, including from CoreWeave, Rocket Lab, Occidental Petroleum, and Paramount Skydance. The S&P 500 up about 100 points here on the day. We wait for the numbers to settle, but no matter how you cut it, it's going to end up higher by roughly about 1.5% on the day. The Dow up 0.8% on the day. The Nasdaq Composite up 2.3%, and the Russell 2000 getting in on the action, gaining about 23 points or 0.9%.
All right, let's go to the S&P 500, Romaine, and you've got most names in the index higher today. 313 to the upside, and Katie, 188 to the downside, 2 unchanged.
Let's take a look at the sectors as measured by my friend The Circle. And you can see that, again, a risk-on day. Look at information technology. That is bright green. That was one of your big gainers today, up about 2.7% as a sector. Communication services also higher by about 2.5%. Consumer discretionary, industrials, the list goes on. In terms of what didn't exactly perform today, on the downside, you have consumer staples, real estate, and utilities. But again, that too fixed into this risk-on behavior that we saw.
All right, I'm going to go to the individual gainers. Let's start with Palantir. Shares closing almost 9% higher. Its best day since April 9th. So that stock, a top gainer in the S&P 500, also the NASDAQ 100. Keep in mind they were down about 11% last week. But jumping in today's session, I will point out Michael Burry and his Scion Asset Management. Remember just revealing about 1 week ago in a filing, a 13F filing, that at the end of September it owned a bearish put options on 5 million Palantir shares with the value of about $912 million. But there's been this back and forth evaluation on this one. Many say way overvalued, and we certainly saw investors rethink it last week. But nonetheless, investors coming back in a big way. Semiconductors, I mentioned, definitely some outperformance in the overall sector today. I got to mention Micron Technology. This was one of the outperformers, up about 6.5% in today's session, and a top gainer in both the S&P and NASDAQ 100. Micron, too, was up about 6% last week, even though the SOX was overall down about 4% last week. But again, investors continuing to move into it. You also had TSMC. Got to mention that one. The ADRs that trade here up about 3%. That despite posting its slowest growth in 18 months amid the AI bubble debate. So that's been going on. And then I'm just going to mention Elf Beauty really quickly, up more than 8% after announcing today the brand's official launch at Ulta Beauty in Mexico. And just because I don't want Romaine to get on me, I got to mention C3 AI. That stock, just a quick bump, up as much as 12% intraday on the news from Reuters that they're exploring a potential sale or some other options, but the stock finishing with about a 3.6% gain at the close. So I'm done. All yours, Tim.
Anything, Romaine?
No, not yet, Tim. Let's see what you got.
Okay. Can't wait. I want to go with decliners. Shares of U.S. healthcare insurers and hospitals fell, including Centene, down 8.8% today. This as lawmakers come closer to ending a government shutdown without securing an extension of the Affordable Care Act. This was actually the worst performer on a percentage basis in the S&P 500. Now, as part of the Senate deal to end the shutdown, Democrats were able to obtain a pledge for a separate vote on healthcare tax credits in the coming weeks. Oscar I know.
They fell for that?
Yeah. We asked this question actually to Henrietta Trey's a little earlier.
Yeah.
And whether or not that vote would happen or if Republicans would, come to the table in good faith. And she said that's the question she's been getting most from clients this afternoon.
What does Kalshi say? What are the prediction marks?
I haven't pulled it up.
Yeah. Me either.
Right now.
But I know what it says.
What does it say?
Probably 0.
Okay. Oscar Health, an honorable mention, fell 17.5%, another health insurer today. Shares of American Airlines also falling today, down 2.5%. The company said weekend operations were challenging amid the government shutdown.
Challenging?
I think challenging. Many people who were trying to fly, regardless of the airline, would agree that they were challenging.
Yeah.
1,400
bad it was,
flights
Tim?
were canceled.
I almost flew Frontier.
Ooh.
Almost.
Almost.
Oh, wow. That's really harsh.
Did you almost fire up the jet, Romaine?
Believe me, trust me, I was calling every friend I had in the book.
Is anyone flying north?
Yeah, pretty much.
You could have done the show from the Miami.
I was just going to stand outside, Palm Beach Airport and just hitchhike.
I mean, to be fair, plenty of planes are going that way. I always think about that.
Yeah.
You could have looked at an empty leg or something. Anyway, another few numbers here to just think about. American Airlines, government shutdown, canceling 1,400 flights. The company saw over 57,000 delay minutes. This is according to an email statement by David Seymour, the company's COO. They also said that 250,000 customers were affected. Separately, Bloomberg's second measure out with some data that drew from a sample of credit and debit card purchases made by U.S. customers, and it said that transactions observed by second measure showed the biggest decline among airlines companies for the month ending October. That was American Airlines, down 6.5% from a year earlier. And finally, Metsera shares falling by close to 15% today. This after Novo Nordisk declined to further raise its offer for the company. They make experimental weight loss drug. That bidding war between Pfizer and Novo Nordisk coming to an end. Pfizer getting victorious. We spoke to Bob Langworth about this. He's got a great piece on the Bloomberg Terminal about how this deal came together with a little help from the U.S. Federal Trade Commission.
We should point out yields actually slightly higher on the day, despite what the market seems to think, which is that we are going to get some more rate cuts given the state of the economy and the potential of that government shutdown to end. Meanwhile, we are keeping an eye on earnings. We're waiting to hear from CoreWeave, and we're starting to get a trickle of news right now on Paramount Skydance. I don't actually have the numbers for you just yet, but reading through the shareholder letter that they've put out, they're talking a lot about the cost cutting and efficiencies that they've seen. The company says that it sees about $3 billion plus in total efficiencies now in what they're saying is the first 100 days since they basically closed out on that deal. The company also talks about investing in the business, and get this, they're also talking about implementing price increases in the United States early in the first quarter of 2026. So, of course, David Ellison, who is just now sort of taking control over this company, putting a stamp on it, looking to raise potential prices there on its customers and scale back costs to a certain degree, $3 billion in efficiencies. That's up from the $2 billion that the company had previously telegraphed, and now learning that the company plans to reduce its workforce by an additional 1,600 employees.
Let's put a pin in Paramount right now and quickly talk about the real reporting earnings here. You can see shares are actually soaring after hours. They boosted their full year revenue forecast. They also beat estimates when it comes to the look behind. Let's start there. The third quarter adjusted loss per share coming in at 4 cents. The estimated loss per share had been for 5.6 cents, so a little bit narrower than expected. You think about the look ahead here. The Real sees fourth quarter revenue $188 million to $191 million. The estimate had been for $179.5 million, so that range ahead of the estimate. You can see the Real again, shares now up about 10% after hours, Tim.
Still waiting on those numbers from Paramount Skydance. Worth repeating some of these headlines. The company sees at least $3 billion in efficiencies, saw $2 billion. The company will reduce its workforce by 1,600 additional employees. And as Romaine mentioned, to implement the price increases. Romaine, the price increases, you got to pay for the over $7 billion in for the UFC rights that David Ellison bought. The stuff with the Duffer Brothers, famous for the Netflix series Stranger Things, right? And then the Free Press, which was relatively small compared to some of the other acquisitions.
Hey, just real quick on the numbers, and one reason why it's taken a while for these numbers to get out. I mean, they have released them, but they're actually doing a very sort of adjusted number base on these, basically taking a very short period from when the deal was basically completed in August through the end of November. So you're not going to really get any comps here. They are providing providing a bit of guidance here, and we're going to take some time to dive into that to make sure we do get it right. But it looks like they're telegraphing roughly about $8 billion in revenue going forward on a forward basis here. But give us some time, and we will break down those numbers for you on Bloomberg Television when we come back after the break.
All right, and we are continuing to watch that one in the aftermarket as we get more information. Just let me pull it up real quickly on the Bloomberg, and you're looking at Paramount now up about 1.5%, 1.9%. But again, here's a quick headline I'll just throw out. Paramount sees 2026 revenue of about $30 billion. So we're continuing to parse and get the numbers out. All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on the close on BTV, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. Paramount Skydance now up about 3.5% after market.
We're keeping an eye on those earnings out of Paramount Skydance, oscillating between gains and losses. When we come back, a full breakdown here of what we learned. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
I'm Romain Bostick.
And we do have breaking news coming out of CoreWeave reporting revenue for the third quarter that beat the average analyst estimate. They also beat when it comes to sales. You take a look at their third quarter adjusted EBITDA coming in higher than expectations. Their net loss also well below expectations, coming in at $110.1 million. The estimate had been for $299.6 million. So certainly better than expected there. And you can see the shares rising about 2% right now, Romain. This, of course, being one of the IPO darlings of 2025.
Absolutely here. And we're also keeping an eye on Paramount Skydance as well. Those shares moving higher. We should point out the company is reporting earnings, but only for a truncated period from basically August 7th through November 30th here. So you're not going to really get a good comp. But here's the forecast. The company says that for the current quarter, the fiscal the fourth quarter of 2025, they're expecting revenue in a range of $8.1 to $8.3 billion, and for the full year 2026, so looking forward over the next 12 months, $30 billion in revenue here. On an adjusted basis here, they're using EBITDA and about $500 to $600 million in the current quarter and about $3.5 billion for the full year going forward. The real headline, though, is the company is really articulating in their shareholder letter their outlook here for how they plan to run the business. $3 billion in efficiencies, about $1 billion more than what they had previously forecast, cutting about 1,600 jobs, and a commitment here to a wide variety of an entertainment slate, including live sports and, of course, movies as well. Joining us right now to talk a little bit more about this is David Joyce, Seaport Research Partners Senior Analyst. And David, ultimately, when you take a look at where David Ellison is nudging this company, and I was looking through the shareholder letter, he kind of does sort of chart a path for at least what content looks like, more importantly. And I'm curious if you think that content strategy translates into actual revenue growth.
Well, I think they do have to populate their services, especially Paramount Plus, with more theatrical and episodic content. So that's really the vision is you have to build it, and hopefully they will come. That was part of the strategy for paying up for UFC rights and making that part of the Paramount Plus without having to pay for a pay-per-view pay through. So I think the commentary about trying to accelerate the content production is something that should be well received by the industry, even though on the other side of that, you do have a lot of headcount reduction as part of their synergies. But this, you do have to differentiate with content. You need more scale in the content because the scale side of the question mark on will this work is really what's driving the overall industry consolidation theme.
And when they talk about the potential cost savings, they point out that some of those cost savings are going to be actually reinvested back into the business, including more than $1.5 billion next year into their DTC properties like UFC, Paramount Plus, Originals, et cetera, David. I am curious about sort of where you want Ellison to sort of push this company? Because I know there's still a lot of talk about whether they do make a meaningful bid for Warner Brothers Discovery, or at least a bid that would actually be accepted by Zaslav. But the idea here that is this more of a content play, or do you think that they can sort of achieve what they need to do with what they already have?
I think this is a content play, but it's one that's going to evolve with new distribution outlets as they emerge, and that's the whole idea behind David Ellison being, tech savvy and tied in with the, with the technology side of what can facilitate, the future entertainment. So they do need to drive up the amount of content they have, but they also have to be flexible in how they go about producing it and embrace new distribution methods. So I think that's this is the first step in David's opportunity to reinvent the company, is redeploying the cost savings into more content and into embracing the new and future distribution models.
Well, when it comes specifically to Warner Brothers and whether or not Paramount acquires that company, we know that Netflix, Comcast, for example, also reported to have some interest here in Warner Brothers. And with that being said, I mean, does Paramount have the firepower, so to speak, if we were to enter into a potential bidding war? And do you think that that's something that they should enter into at all?
A few concepts are involved in answering that question. One is on the regulatory front. And this would not be, I think, problematic from an antitrust standpoint in terms of combining a couple of studios. If you looked at putting Comcast Universal together with Warner Brothers studio, that might be too big from a regulator's point of view. But Paramount and Warner Brothers, because Paramount's been a smaller studio, would probably not be problematic. Also, with the continuing decline in the cable networks business with cord cutting, putting the Warner Brothers Turner networks together with Paramount's also, I don't think, would be problematic, because there are so many voices, so many outlets for people to access content. So I think that thinking of the potential deal structure, Paramount could be a one-stop shop for a Warner Brothers Discovery board to simplify everything, to put both aspects together. Whereas a Comcast deal could involve some separate assets. Netflix is also said they just are interested in the studios and streaming side. So the question for the Warner Brothers board is, what do we do with the cable networks in that instance? So I think that strategically and from a regulatory perspective, Paramount might have an upper hand. Financially, they could, but that could really rely on what David's father, Larry, decides to do. Could he take some of his Oracle shares and margin it, and that be a way that he keeps his control in Oracle, and then can use that the cash as part of the compensation for Warner's deal? So I think that they could keep up with some of the other parties in terms of the financial firepower in doing such a deal.
All right, David, really appreciate your time. You take a look at Paramount shares up about 2.4% right now. That is David Joyce. He is Seaport Research Partners Senior Analyst. Now coming up, also keeping an eye on shares of CoreWeave, moving after reporting their latest quarterly results. Up next, we're going to take a closer look at those earnings and what they mean for the broader AI trade. This is The Close on Bloomberg. Shares of CoreWeave a little bit lower in after-hours trading after the cloud computing company's latest earnings report, coming in higher than estimates. And let's discuss now with Sarah Kunst. She is managing director and founder of Cleo Capital. So when it comes to quarterly sales, it looked like that tops estimates. And part of the reason that we're keeping such a close eye on CoreWeave is because it's one of the IPOs that has done best this year, and also because there's a lot of concerns right now, Sarah, about the durability of that AI trade, whether or not the ROI is going to be there when it comes to the massive amounts of spend. I know you've only had a couple minutes to take a look at these results, but what's your first reaction here?
It's interesting to me that, this wasn't a bad result, but I think that the company's not had the best quarter and not showing up in these numbers. I think they would have really needed a miracle to get a big uptick instead of this sort of down to flat.
A little down to flat, that's certainly the reaction coming through after hours. I mean, couch this conversation in the context of where we are when it comes to all of these massive deals that we've come through, especially when it comes to financing the build out of these data centers. There's a concern here that perhaps this industry is overbuilding. And it seems like the hope, as you point out in your notes, is that you build it, they'll come. Sarah, I wonder how much money you can actually put behind that.
Yeah, I mean, you don't normally see this kind of sort of investing for growth in an infrastructure company. It doesn't take that long to get these things online. And so, I think that when you look at the CapEx of this company, when you look at things like, the rate at which the CEO is selling, you say, okay, it feels like this is expensive and I don't know if the value is going to be there in a few years. And I think that the street is reacting that way too, because we're seeing the slowdowns with the Taiwan Semiconductors of the world, and their revenue is the smallest amount of growth, I think, in the last 18 months that they've had. And there's this sort of overarching question mark of, hey, is that AI bubble maybe not popping, but at very least starting to deflate?
Does that leave, I guess, these sort of neo-cloud providers more vulnerable? Because I was always under the impression people would talk about, okay, there's this overbuild to a certain extent when it comes to AI. But the idea is that a company like Microsoft, they still have a lot of demand for just basic cloud services. So if the AI demand doesn't materialize, at the end of the day, they still have something, some potential customers, clients for those services. But how does that work with a company like CoreWeave that, for lack of a better word, just seems kind of like almost a middleman in this whole process?
Yeah, they are. And you can make a lot of money in the picks and shovels business, right? But the problem is that only works as long as there's a gold rush, to really torture the metaphor. And so I do think there's a concern there. My sort of longtime favorite company in the AI space has been Alphabet, because they're in 1,000 different lines of business and they're really, really, really good at AI. I think it's trickier when you're only in sort of one piece of the business, when you don't necessarily have as much revenue, when you don't have a lot of profitability. All of those things added up make the CoreWeave of the world a riskier bet. And I think you even saw some of that in Core Scientific saying, actually, thanks, but no thanks on this acquisition offer.
And it's funny, as we speak, earlier today, there was a headline, some reporting out of Reuters about C3 AI. I know they're a lot different story than what we're talking about with CoreWeave, Microsoft, and Alphabet, but they're exploring a potential sale and options. And I am wondering if we get to a point very soon where we do start to see a little bit of a shakeout of some of the weaker players in this space, where either they look for some sort of M&A to sort of boost their business or maybe just fade into the background altogether.
Absolutely. I just saw a note today from Morgan Stanley saying that M&A is back, and I certainly agree. I think that we're going to see some of these companies quietly have talks with their customers and say, hey, maybe there's a tie-up in the works. And obviously, the biggest potential one for that would be an OpenAI Microsoft tie-up eventually. But I think that a lot of these smaller players are going to realize that they might be better as a part of a huge company that does AI versus trying to brave the public markets alone.
Well, when it comes to OpenAI, TBD if we see any tie-up when it comes to Microsoft. It feels like they just sorted out their structures, something to watch there. But the reporting potentially that OpenAI is a company that could come public. They've been sort of the poster child for companies not needing to go public, finding all the funding that they need in the private markets. But it seems like maybe we're reaching the limits of that narrative, especially when it comes to OpenAI.
I feel like which narrative, right? That they're getting a government bailout, that they're renting data center space, that they're getting into the adults will be adult business, that they're IPOing for $1 trillion. And those are literally just the headlines from, this last couple weeks. And so I think that they have a lot of storylines and they're kind of seeing what sticks, and they're going after that. And so, yeah, I think that it is a tough time right now to be one of these companies that's just absolutely burning money in compute without necessarily a ton of revenue coming in.
But are you seeing overall, and not necessarily for CoreWeave, but are you seeing some sort of return on these investments overall, meaning the companies themselves, or at least on the precipice of doing so?
Oh, my paper returns are great, right? Getting in early to the AI companies has been very, very good for people who are selling secondaries, for your unrealized gains, and then obviously for the people who have invested in, the NVIDIAs of the world over the past couple years. But in the private markets, we see that the vast majority of AI trials fail, and that it's not necessarily saving people a ton of money in enterprise. And so I do think that there is a lot of pressure right now on AI startups and private companies to figure out how they're actually going to make money.
All right, Sarah, got to leave it there. Sarah Kunst, Managing Director, Founder over at Cleo Capital, as we continue our coverage here on The Close. A conversation up ahead with Meb Faber, co-founder over at Cambria, and get his thoughts here on this rip-roaring rally in the stock market and, well, whether it's maybe gotten just a little bit too hot. That conversation coming up in a bit. This is The Close.
Well, it's the end of an era on Wall Street. Legendary investor Warren Buffett says he is, quote, going quiet and speeding up the pace of donating some $1.3 billion to 4 of his family's foundations. Joining us now is Bloomberg's Alex Rajbhandari, who follows Buffett closely and just wrote this story. Alex, I guess when it comes, of course, to Buffett going quiet, when it comes to the annual letters, not entirely unexpected, given that he has handed over the reins.
Right. He's not going to write the annual letter this year. He's not going to speak at the annual meeting. These are big changes for Berkshire Hathaway. But he will keep writing those letters at Thanksgiving when he details a lot of his donations to the foundations of his late wife and his children. So we'll keep hearing from him every year.
Yeah, I thought it was a bit funny. He said that his children, Susie, Howard, and Peter, they're in their 60s and their 70s.
Yes.
And Buffett said that it'd be a mistake to wager that they might all enjoy his, quote, exceptional luck in aging. The man is 95 years old.
Right. So he's preparing for that. He says he wants to step up the pace of donations to his children so that they have his entire estate to give away after he passes away. But he cautioned something. He said, I will keep a significant amount of A shares until shareholders are comfortable with Able as much as they were with him and Munger. So that was an interesting caution.
With regards to just his general role, I mean, we all kind of know a lot of the decision-making, the investment decision-making is being made by Greg and some of the other deputies there. But he still plans to kind of be the face, I guess, as long as he's capable of doing it, right?
I mean, he will be chairman, so he will be on the background. But he did say at the annual meeting when he announced this, surprise that he was giving the reins to Able, he said he will have the final word on all operations and when it came to capital deployment. So Able is definitely going to step up.
I was talking to someone who used to work for Buffett some years ago, who then struck out on her own to do her own thing. And the conversation was about the idea of how big Berkshire had gotten, and the idea that sort of the original ethos of sort of finding these small, underappreciated companies and buying them when no one else cared about them and then building them up over the years into something big, that you can't really do that as well, if at all, when you're as large as Berkshire is with the cash pile that they have. And I do wonder if Buffett or anyone else there has articulated whether the future of Berkshire might actually not be as Berkshire Hathaway. Maybe it's something a little bit more fragmented.
So that's not what Buffett says in his letter. Today he says that Berkshire has a less of a chance of a massive catastrophe than other companies. He says the share is still going to capriciously behave over the next years, but he says he asks shareholders to have some trust in him. So I don't think that's the plan. It is true, however, that it's hard for him to find sizable acquisitions, and we've seen that. The cash pile kept increasing. It's $382 billion now. He says in his letter that there are opportunities coming up still. He goes to the office 5 days a week and goes through them, but he says, given their size, it's not zero, but it's not a lot.
All right, Alex Rajbhandari, who covers Berkshire or all things Warren Buffett for us here at Bloomberg. Of course, the winding down of the era, to call it an end of the era. I feel like we've been saying that now for, for a couple of years now. But again, just one more change here as we await that transition for Berkshire Hathaway. Of course, he is one of the most legendary value investors out there, and that, of course, means a big focus on fundamentals. We are pretty much through the earnings season, at least for the big companies, and so far, the earnings growth has been pretty phenomenal, 14.6% year over year. That's almost double what analysts were expecting heading into this earnings season, but history suggests it's going to take even bigger profits to sustain the record rally that is defined much of the year. Our next guest strategy focuses on the best ways to navigate sky-high stock prices and rising valuations. Meb Faber joins us right now, co-founder and CIO at Cambria Investment Management. Hey, Meb, before I get to earnings, I do just want to ask you a little bit about Warren Buffett. I know you've been a big admirer of his years just in listening to your podcast. And I remember a few years ago, you wrote a great column kind of asking whether Warren Buffett should actually launch an ETF. But it gets to this idea as to whether anybody could really, I mean, we keep talking about who's the next Buffett, but is that even a realistic question to ask? I feel like he came about in a certain time and place that was sort of favorable to that investment style. And I do wonder if that kind of exists, at least at scale, today.
There's so many lessons to take from the GOAT. You know, I mean, we did an old post where we were looking at, you know, people love to talk about is his style broken, his value, you know, kind of lost in the rearview mirror. And you look at how much of his performance is often concentrated in a few years. I mean, think back to the 2000 to 2003 period where he just outperformed the S&P by a mile. And you look at today, maybe not too dissimilar. He's been building up a pretty big cash balance. You know, he loves his T-bills. He's even been gassing up the jet to go to Japan and buy companies ex-USA. A lot of that saying is, look, it's been an amazing run the last 15 years in U.S. stocks. I think the problem a lot of U.S. investors have when they look at this, and the article you were referencing is saying, great, Meb, great, Romain. I know this. I know it's been an amazing because I got all these huge gains, but I can't do anything because the tax man's going to kill me. I'm sitting on a 10-bagger in the S&P since 2009. I got a 20, 50, 100-bagger in these Mag 7. If I sell it, all of it goes to Uncle Sam. And there's been a big development. We've mentioned a few times on this show over the years. Called the 351 ETF exchange. Mm-hmm. And we jokingly said it reference to Buffett because nobody who owns Berkshire ever sells Berkshire, right? They would rather take it to the grave, I think, or donate it. But theoretically, if you had some U.S. stocks or ETFs that you wanted to seed a new ETF with, it's a tax-deferred contribution, kind of like a 1031 with real estate. It's a really cool idea. I think you're going to hear a lot more about it next year. We're doing our fourth one coming up here next month, but it gives investors a way to diversify out of highly appreciated, particularly concentrated stock into the ETF structure, which we know is a very tax-efficient vehicle.
Yeah, absolutely. It feels like the broader audience has certainly been socialized to the idea of 351 conversions. I do want to talk a little bit more about value, and I'll actually go to your ETF, GVAL, the Cambria Global Value ETF, up 48% year to date. You compare that to the S&P 500, higher by about 19.8% on a total return basis. Meb, what is going on? What are you investing in this fund that you're seeing this type of outperformance when it comes, again, to a value fund?
The U.S. has certainly been the premier equity market. You go back 100 years, 200 years, look at the returns. But most investors don't like to admit that a global portfolio does have better risk-adjusted returns over time. If you look at almost any decade, any period, the drawdowns are lower, the volatility is lower. You may have a little bit less return depending on the period, but you've been conditioned to these last 15 years, which have been so exceptional in the U.S. that everyone's forgotten about foreign stocks, emerging market stocks. And if you look at the valuations, Grand Canyon wide today, right? Mm-hmm. You have foreign and emerging who have just been underperformed for so long. The GVAL fund that you mentioned had done so stinky, we wrote an email to our shareholders, like, is this broken? Is it time to leave? Is it bad? And then what you find is that, going back to the Buffett example, these value returns can condense into a very short period. And so you have something like this year, we can go ahead and round up to 50%. That's easier to say. But you have a year where these deep value stocks have just massive returns very quickly. No one's really started to talk about it yet. The sentiment doesn't feel like it's shifted. I think as investors open their year-end statements, start to talk to their advisors, what used to be the question of why do we own emerging markets, why do we own foreign, is going to shift to why don't we own more emerging markets? Why don't we own more foreign? But this is a type of trade that could last for years or even a decade.
Well, I want to go back to T-bills because bringing it back to Warren Buffett, of course, as you mentioned, he's been sitting out in T-bills. I'm taking a look at the notes you sent over to our producers, and you write, don't hide out in fixed income, specifically when it comes to cash. And I think that's interesting, Meb, because that's exactly what a lot of investors are doing as measured by money market funds. And I wonder what finally breaks the fever here when it comes to just this insatiable demand for cash.
Yeah, so what we've talked about with stocks, I feel like is very well known. Everyone knows U.S. stocks are expensive, so what? They're waiting for the musical chairs to end. The fixed income place is a head scratcher, and so you need to distinguish between the different types of fixed income. T-bills we think are actually totally okay, or money market-like investments. What's not okay, at least what looks like historically, is all the other risky bonds. And it doesn't even matter which ones you even talk about. Corporates, some of the lowest spreads we've ever seen. We wrote a paper on this a couple years ago, launched a fund based on it called TYLD, but it just chills out in T-bills until the spread is wide enough. It's almost like a value approach to fixed income. And so if you look at the entire curve, doesn't matter if it's 10-year, 30-year, corporate, junk, mortgage, even quasi-yielding investments like REITs, TIPS, none of them have enough yield. And if we know anything about these types of markets, when you have a dislocation, things like corporate bonds can go from yielding 5 to, in a snap, 8, 9, 10, junk, double digits, emerging markets. Historically, it's been a horrible idea to invest in these risky bonds when they don't have much yield spread relative to T-bills, which unfortunately is where we find ourselves today, which is one of the reasons probably Warren's hiding out in these nice T-bills.
Well, Meb, unfortunately, we have to leave it there. Great to get some time with you. That is Meb Faber. He is co-founder and CIO over at Cambria Investment Management. Meanwhile, we do want to bring you some breaking news when it comes to the asset management landscape. Janus Henderson, this interesting Bloomberg News breaking the story last month that Trion is seeking a buyout of Janus Henderson with General Catalyst. Now Janus Henderson naming financial advisors, legal counsel to a special committee to evaluate that bid. Apparently, the committee has retained Goldman as its financial advisor, but it does not tend to comment on the proposal specifically. You can see the shares unchanged right now, but certainly a story to keep an eye on when it comes to the M&A landscape.
And you talk about, I mean, obviously Trion has had like a 20% stake for the last few years now. Then we had that filing, of course, last month, just maybe about 2 to 3 weeks ago here, where they talked about that $46 a share offer for the company. It'll be interesting to see here as to how far they actually take this. Again, the headline there on your screen here, Janus Henderson retaining Goldman as a financial advisor. This is The Close on Bloomberg.
Two sides of the AI story on display today. Taiwan Semiconductor notching gains after posting its slowest growth in 18 months, adding to concerns around the AI boom turning into a bubble. But SoftBank's results tomorrow could give the bulls a fighting chance, with the street expecting a third straight quarter of AI-fueled profits. Joining us now is Joe Fath. He is partner and head of growth over at Eclipse Ventures. Joe, great to have you with us. So where are we when it comes to the AI trade? Because certainly you take a look at this trade, it's not a monolith anymore where all the stocks involved are sort of moving together. It feels like there's a bit more nuance that's arrived.
Yeah, agreed, Katie. Good to be with you. It's interesting, right? We had a pretty big downturn in 2022, and we've been kind of straight up since OpenAI launched ChatGPT in December of 22. 3 pretty powerful years in front of us. I think the debate, right, there's always a debate around the AI bubble. I think it's difficult to call a bubble at any point in time. You usually don't know until after the fact. But valuations are stretched, particularly as you look at free cash flow relative to PE, even among the Mag 7, right? And all that investment spend is going to have to turn into returns over time to justify that spend. The big 4, Meta, Google, Microsoft, and Amazon, are going to spend upwards of $350 billion in capex this year. And based on commentary in the calls, it's going to be well north of 400 next year. And we're going to have to get returns on that spend. So I think there's a big narrative around AI, and there's a lot of uncertainty still. So hard to ultimately say where we're at, but I'd say we're in the later innings rather than the earlier innings.
Well, it's interesting to hear you bring up some of those different metrics, especially when it comes to free cash flow relative to PE, because as you mentioned, we know a lot of these big tech companies have been tapping their free cash flow, using that as a source to sort of fund their AI ambitions, especially when it comes to the data center build out. That's part of the reason why you're seeing a lot of these companies turn more to the bond market. So when it comes to investors really looking for that ROI, really looking for a return when it comes to that investment spend, to your point that we're in the later innings here, I mean, when do we really see push come to shove and maybe investors lose a little bit of patience with these ginormous capex figures?
Yeah, I think you're seeing a little bit of that now, right? Based on some of the reactions to earnings, Meta probably being the most pronounced example. think that the top line, the bottom line were very solid, right? They continue to be, but the OPEX spend as well as the capital expenditure spend has people more nervous. But look, there has been some pretty powerful, I'd say, trends in the area where AI is having an impact, whether it be in creative content development, whether it be in software coding, or even in customer service. How expansive that's going to be to justify hundreds of billions and ultimately trillions of dollars of spend is the open question.
I am curious in terms of how you sort of value some of these businesses, and maybe you can draw on your experience prior to going to Eclipse and how you value public companies. And I am curious as to what translates from that to some of these private valuations, particularly in light, I guess, of the different dynamics, if you will, and how some of these companies are being managed.
Yeah, look, at the end of the day, I think free cash flow is king, and that justifies whether a valuation is worth it or not over time, right? You need to focus on that. Now, again, I think with these companies, right, you have to look out and decide whether the spend ultimately is going to pay off in returns. And when in my role at T. Rowe Price before I joined Eclipse, we really focused on durability of growth and how durable was that growth profile for the investment that was being made. And that's the ultimate question at the end of the day. And as we noted on the onset here, there's some bifurcation, and you need to focus on each individual company and analyze them for their own merits.
Well, then I'm curious as to the bridge between the private and public markets. We were speaking a little bit earlier with an investment banker over at Mizuho Americas, and she was talking about, in her words, the 30,000, captive companies under the PE umbrella, and that doesn't even take into account all the private companies that are captive in the VC space here. Is there incentive right now for some of these companies to actually go public? Do you see maybe a potential opening of that IPO market? Not so much, well, let me rephrase that, not so much an opening of the IPO market, but for those companies to actually go through that door?
Yeah, look, it's a great question, and I think more companies have stayed private longer for a couple of reasons. The secondary market's been strong for shares. They've been able to sell equity to investors, and they've been able to provide liquidity to their employees, right? So that's been a big part of it. The other side of it, too, in all honesty, I think it's difficult to be a public company. The SEC clearly has very restrictive rules, and folks, it's difficult to be a public company and to have more and more resources and capital around that. So I think some of those things have to change. There's a couple, a handful of very big private companies, as you know, OpenAI probably being the greatest example, followed by ByteDance, SpaceX, Databricks, and Stripe, though, to name a few or several. If they come public, I think that would be great. And again, during my time running growth stock fund at T. Rowe, when I started in 2014, there was about 650 names in my primary benchmark, the Russell 1000 growth. That's down to about 350 names now. So there is a supply-demand problem in the market, and we need more companies to go public over time.
Yeah, it's fascinating to sort of watch that shrinkage of the public markets over time, Joe. And I mean, when I think about your portfolio, when you're investing in a company, how much is the potential exit on your mind through the path of an IPO? How big of a factor is that for you when you're considering putting some money on the line?
Yeah, I always tell people that earnings and free cash flow is really the science of the job, and the ultimate multiple you get is the art of the job. But both of those matter ultimately to the valuation you get and the returns that you get. So multiples clearly harder, but I think you also need to be receptive to how the public markets are going to treat an equity once you bring it public. And that's not just institutional investors. It's also how retail investors are going to treat that stock, given how important part of the market retail investors are today.
Hey, Joe, really appreciate you coming on, and not just because you're a smart guy, but, as a fellow Chicagoan, despite the fact you're a Cubs fan, welcome you here on the program anytime. I know the White Sox didn't hold up this year, but maybe next year.
I appreciate the time. Take care.
Joe Fath, partner, head of growth at Eclipse Ventures. As we roll towards the end of this show here, we're going to check in on what's been going on in Washington, D.C. Of course, a lot of optimism right now about the potential for a deal to end the government shutdown. We'll check in with our folks down in Washington when we come back after the break. This is The Close on Bloomberg.
President Trump telling reporters that he supports the bipartisan deal to end the longest U.S. government shutdown ever. Let's talk about this timeline with Tyler Kendall joining us from Washington. So Tyler, bring us up to speed here as to how the next 36 hours, the next couple of days look, and when we actually get the shutdown ended.
Yeah, hey, Katie. So we're closer, but it's not a done deal yet. A person familiar tells us that the Senate is set to vote at 5 p.m. Eastern on a key procedural vote to essentially open debate on this package. Any one senator could delay this indefinitely, but we are expecting one of those senators that we've been watching, Rand Paul of Kentucky, to get a key concession in order to keep the ball rolling here. Because once they're done with debate, then that sets this up for final passage. And then it kicks over to the lower chamber in the House. And House Speaker Mike Johnson still has his work cut out for him. But as you mentioned, President Trump did lend his support to this package less than an hour ago, which is seen as a boost here because House Speaker Mike Johnson is going to need as many Republicans as possible. He likely can only afford to lose 2 to ultimately advance the legislation.
What about the Democrats, Tyler? I am curious about some of the reaction that we've seen amongst House Democrats to this potential deal that Senate Democrats appear to have agreed to, and some of the backlash. The idea that maybe they didn't think that the Senate leaders held the line or fought hard enough to include some of those ACA provisions.
Right, exactly. Many Democrats are upset, including those that we've spoken to on Balance of Power, who say that this promise that there's going to be a vote once the government reopens on extending the Affordable Care Act premium subsidies just isn't enough. But those 8 Democrats in the Senate, the moderate Democrats that got on board with this plan, said that after 40 days of negotiations, this really was the best they can do. I'll also point out that these 8 Democrats, importantly, all aren't up for re-election. And perhaps that gives us a little bit more insight into the strategy that they had going into this. But it's going to be a keen issue. We did hear from House Democratic Leader Hakeem Jeffries earlier today lend his support to Senate Minority Leader Chuck Schumer. So for now, they appear to be on the same track.
Tyler, Kendall down in D.C. here as we wrap up the close, a push ahead to what the markets will have their eye on. Of course, they will be focused, Katie Greifeld, on what goes on in Washington. But just a reminder, tomorrow is Veterans Day in the U.S. Observances means that the U.S. stock market is open, but the bond markets will be closed.
Yeah, one of those funky days. We also at 6 a.m. Eastern get NFIB small business optimism, going to be an important check, of course, on how the lifeblood of the economy is feeling right now.
And we're also going to get some Fed speak, including out of bar and more earnings as well, including from Cleo, of course, which has sort of been a big darling in the market over the past few months.
Absolutely. But that does it for the close.
Thank God, Katie. I haven't slept in 72 hours.
There you go. This is the close. Have a good evening.